One thing we know for certain in 2025, there will be massive tax law changes. What will these changes be? How will they go about paying for these changes? And how will it impact you and your business? That's what we're going to discuss today on the Wealthability Show. And I have my good friend, Garrett Watson from the Tax Foundation, back again with us to explain how all this works. Garrett, welcome back to the Wealthability Show.
Thanks for having me.
So Garrett, you're a senior analyst, right? The Tax Foundation?
That's right, working on federal tax policy.
And how long have you been doing this?
I've been at Tax Foundation for a little over 6 years, so seen a lot of the ups and downs over the last half decade on tax. It's been a pretty busy ride.
So you were here, you weren't there during the 2017 law.
Yeah, it was just after the law was passed, though I was in DC while that debate was happening, and we're going to have a recurrence of it, I think, this year in a lot of ways.
Yes, for sure. And it's so many interesting things to unpack here. For our listeners, the reason we're doing this is because in order to predict what's going to happen, we have to understand how the process actually works. And once we understand how the process works, we can go, well, you know what, these things very unlikely to happen. So we don't have to plan for that. Whereas we look at other things that we go, oh, okay, well, this is going to happen. And then there's the question of the deficit. So I know a lot of our listeners, most of you are entrepreneurs, you're investors. You actually are concerned about what's going on in the country from a deficit standpoint. And how do we do this with that? Does it really, do tax reductions really pay for themselves by stimulating growth, or what happens there? And I actually want to start with that, Garrett, because that is kind of a theme and of some of the policymakers in the Republican Party right now, the tax policymakers, is that, hey, tax reduction will stimulate growth. In your analysis at the Tax Foundation, do you agree with that generally, or is it specific policies that generate growth as opposed to all tax reduction generates growth?
Yeah, I think that's a key part of the debate, which is what is the connection between these tax policy changes and tax policy in general and economic growth, the state of our economy? Because the centerpiece of what Republicans did in 2017 was trying to get us out of some of the economic malaise that we had been dealing with for the 8+ years after the Great Recession, right? To really motivate economic growth. And their theory was, by reducing tax burdens, but more specifically, encouraging incentives for investment, incentives for hiring, that would spur higher economic growth. And that really motivated a lot of the design of those tax cuts, including changes to cost recovery, lowering that corporate tax rate, trying to provide a deduction for pass-through firms, lowering the rates and brackets. And so what we found, and many others have found in the both in theoretical modeling and in a lot of the empirical work, is it did reduce tax burdens to investment. It did spur some additional investment, particularly in the first few years after the tax cut. And that's motivating a lot of Republicans now to say, how do we continue that story coming out of the pandemic to try to revive growth? We know the incoming Treasury Secretary is big on this, trying to get the U.S. back to a 3% growth path. But there's a couple of challenges there, right? One is, as you mentioned, there's always a risk of potentially overstating your case. And in the case of tax cuts paying for themselves or trying to, say, double the rate of growth, it's hard, right? It's actually hard in our economy, being an advanced economy, a large economy, to really rev growth to that level through tax policy alone, though it does have some positive effects. What we find is there is dynamic effects from growth, from making sure that incentives for investment are maximized. And that can reduce the net cost. We find it's somewhere around 10% of the cost is offset by additional payroll and income tax revenue from economic growth. So it definitely helps. It is, an argument in favor of continuing these reforms. But we just want to be careful not to overstate the case because, of course, critics of the 2017 tax law and of potential tax changes this year are going to say, oh, hey, this is all overstated, and we don't want to give them that ammo. The other just quick point I think it's important is a lot of the pro-growth changes that happened in 2017 were actually made permanent. So the corporate rate changes, some of the international changes, those are actually already baked into the current law. So those will be off the table for policymakers this year. They're going to be focused mostly on the individual side, which does have, of course, some pro-growth effects for sure, but it's a different, sort of dynamic effect than those corporate changes that were made permanent. So that's another thing they'll have to balance. The last thing I'll say, of course, is this is all going to be in the context of other non-tax changes that will also be used as an argument to spur growth. So energy changes, changes to regulation, all of those things may also change the full dynamic score that we see from the Hill.
And then we have the potential breaks from tariffs, right? So
Yes.
there's the little braking mechanism there, which, I'm actually kind of like that we have both acceleration and braking, right? If you're driving a race car, you use your brakes and you accelerate, and they're both important. And so, tariffs being a little bit of a braking mechanism on consumerism, basically, consumer spending might, in a way, just kind of offset some of the maybe even the inflationary aspects of tax law changes. So let's start with if you go back to 2017, I'm sure you have done this. If you go back to 2017, how close were the Republicans in their estimates of how much growth, how much tax growth would happen as a result of tax reduction?
Yeah, that's a good question. So, of course, I think one challenge in 17 was there were widely divergent predictions on what may happen coming out of the tax cuts. So, on one end, I think a lot of the advocates were saying, "Hey, we're going to see big changes pretty quickly, right? In terms of multi-thousand-dollar increases in wage growth, right? Maybe getting up to a 2, 3+% real growth rate." And then, of course, you had in the middle, maybe folks, we did some scoring. The Congressional Budget Office did some scoring to project changes in investment, changes in revenue, to see that to generate the dynamic score we mentioned earlier. And then, of course, you had some of the hardline critics who said this thing's going to do nothing but give money to the rich or whatever, right? And so there was that sort of range of predicted outcomes. Of course, it's always challenging because the relevant comparison is counterfactual. What would the world have looked like had everything run except we didn't pass the 2017 tax law? Very hard to tell because, of course, we had a trade war in 2018. We had the pandemic in 2020. It creates a lot of noise in the data set. But the best we can tell from the best studies that have been done by many academics who, quite frankly, are not big advocates of this tax law, find that there was an increase in investment that we did see in some cases noticeable. 10, 15% increase in investment in sectors that were most impacted by the tax law. And we also saw increases in wage growth relative to a world where this didn't happen. And so I think that is, pretty compelling evidence that the law did deliver in many ways. Though I think it is important to clarify that maybe not as strongly as some of its most, strenuous backers predicted, right? We didn't see some of the more, extreme claims as it relates to it paying for itself. Though, some people have pointed to, and I think it's a nuanced discussion, that we did see actually bigger revenue growth than even the Congressional Budget Office predicted, right? North of $1 trillion over 10 years. That's because both of inflation, stronger profits than was otherwise predicted. We, of course, had a lot of immigration that contributed to this. And so even though that may not tell us whether or not the law paid for itself, it does say that we had some more fiscal room, more additional revenue than we were predicting. And so that's also, I think, informing some of the way in which Republicans are thinking about, okay, what should the deficit target be? Should we fully offset this? Do we need to? That all plays into it. But I will say that the 2017 law will, I think, continue to be a case study over the next, not just the next few years, the next 20 years, it'll be studied on what can we really learn about how tax policy influences behavior. And I will say that there weren't any major surprises there, despite all the noise and political debates. We reduced incentives or burdens on investment, and investment did go up. And I think that's something we continue to build on moving forward in combination with other changes, of course. I think that's the other thing is tax policy is important. It's important to also make progress in other policy areas too, to all move in the right direction.
Yeah. So let's look at, okay, which tax reductions have the biggest impact? You kept saying several times, you said, well, we had a reduction, increase in investment, right? Reducing
Right.
taxes on investment. So what are you talking about specifically there as an example in the 2017 law that we might look forward to 2025?
Yeah, so there's a couple things there. Of course, I guess one important point that may not be known by folks following along with us, of course, is that the 2017 tax law had a combination of permanent and temporary changes. So a lot of the changes were made permanent, most notably a lot of the corporate changes, lowering that rate from a top rate of 35% to a flat 21% rate. We've made a lot of pro-competitive changes to the international tax system for corporations. Those are made permanent. There were some permanent changes for individuals, but a lot of those individual changes, for procedural reasons we can get into a little later, were made temporary, and they expire in bulk at the end of this year, which is what's motivating a lot of this discussion about tax. And so that means we had a combination of temporary and permanent changes. When it comes to and I think it's a really important point, that not all tax changes are the same. That tax changes when it comes to economic growth that really increase the incentive to invest on the margin are much more impactful than tax changes that don't change behavior, right? I think that's sort of intuitive. And so, we and others find, of course, that the corporate rate changes, the corporate rate and the corporate base changes were important for growth, mostly to make us more competitive, to stop a lot of the inversions and profit shifting behavior we saw prior to 2018 when they took effect. But there were other changes, on the individual side that are going to expire that also impact businesses that were also really important. One big one we're big fans of course, is enhanced cost recovery. So allowing firms to immediately and fully deduct the cost of investments when those investments are made, contrary to underlying law, which requires firms to deduct those costs over time. That was provided for short-lived assets temporarily from late 2017 through 2022, and then began to phase down, and it'll be phased out entirely by 2027 to go back to prior law. We also, of course, switched R&D expenses to amortization over 5 years. That's another penalty for investment that's moving in the wrong direction. So we find that change is pretty, for the revenue cost of the government, the economic growth potential is pretty large, especially because it's a timing change, right? A lot of that is changing the timing of when firms take deductions and therefore pay tax to the federal government. There's also, of course, growth effects from the rates and brackets changes, which for everyday taxpayers, that's probably the single largest thing they're going to run into, right? That, along with the standard deduction doubling and changes to the child tax credit. And so there's some growth incentives there when it comes to labor supply, labor decisions, as well as business owners who are taxed under ordinary income taxes. And of course, there's another discussion about what we did for pass-through firms. So most notably, of course, the 1 INA pass-through reduction for qualified business income, which is also scheduled to expire at the end of this year. That was, advocates of that provision argued that not only is that going to be a helpful, incentive for investment, for hiring for pass-through firms, but it also ensures that there's at least some equal footing between, your sole props, your S corps, your partnerships, and C corporations, to ensure folks aren't changing business form for tax purposes, which can be, inefficient and have a variety of negative consequences. And so this all sort of adds up, to the aggregate effect that was predicted in terms of the economic effects. I think it is important, though. Another thing we emphasize is if we can make as many of the biggest sort of pro-growth provisions permanent as possible, that would be most helpful. Both because, of course, you expect long-run growth from permanent policy, but also provide certainty for taxpayers. It's it can't be positive for business formation, for investment, if they don't know what the tax law will be in 5 years. There's already a lot of uncertainty about the political debates and who's going to be in control. That we can't control, but we can control from a policy perspective what's scheduled to expire and what's permanent. And so this is an opportunity, I think, to at least make some of it permanent. It might be overly optimistic to think all of it is made permanent, but that's another thing we're trying to emphasize in the debate is providing that certainty for business owners.
Yeah, makes a lot of sense. So one of the things I'm hearing is there is this question of which is more important, investment or consumption when it comes to growth in the economy. And, you've talked a lot about investment. The bonus depreciation is investment related. The 20% deduction is potentially investment related. Corporate rate reduction, very much investment related, right? And is particularly investing in in U.S. companies as opposed to overseas. And so, how do you analyze that between, okay, so a lot of Trump's campaign policies his campaign promises were about individuals, right? They were not business campaign promises. I mean, they were overtime pay, not taxing Social Security, not taxing tips, deduction for um, uh, interest on cars made in the U.S. I mean, these are all consumer
Hmm.
driven tax promises or tax policies that he was talking about, which is really in contrast to uh, the major reform in 2017 was
Hmm.
business, right? Between the bonus depreciation in real estate, where it generated, I've seen a lot of housing built, and a
Mm.
lot of it because I'm involved in this on a daily basis. The bonus depreciation had a huge impact on the
Mm.
amount of housing that was built. It had a huge impact. I don't know if it's been measured, but I can tell you because from my own what I see is that it had a huge impact on
Mm.
investing in multifamily real estate. So what's your take on that at the Tax Foundation as to, you know, do you have to emphasize all of one? Is it one versus
Mm.
the other? How do you balance that?
Mm. Yeah, that's a great sort of fundamental question because, of course, it comes down to the fundamental question of, why do we invest? We ultimately invest and defer consumption now, which is what we're doing by saving and investing in these projects to create additional growth to consume more later, right? And so, to some extent, choosing in the long run, right, is sort of a philosophical point, but the choice between investment and consumption is ultimately a question of when we're
It's a
consuming
little
and
bit
how
like the
that's
difference between
trade-off.
eating. It's a little like the difference between eating a steak and a candy bar, right?
Right, exactly. Yes. Yeah. So do you defer consumption now, defer that pleasure to get more in the future? And of course, it is a balance, right? Because we don't want to. And this is people understand this in their personal lives, right? You don't want to live on maybe nothing for a future that may never come, right? So there's always that balance, and that's true in our economics and our policy making, right? Where in the 2017 tax law specifically, right, we did have a lot of forward-looking investment incentives to further, defer consumption and allow for more productivity for the future. But we also had, yeah, tax cuts for everyday taxpayers to encourage to help families with children, right? To increase their standard deduction. There's other considerations in tax policy beyond just growth. Simplicity, of course, is another important consideration in a lot of the decisions they made. And what we found was we and others in the space is that the tax law did have an impact both in terms of short-term consumption and in the long-term changes. So there was some boost, for example, in 2018 and 2019 to, people talk about wonks in the space, talk about consumption multipliers, right? And more money flowing in the economy. That did happen. It seems like a bit because people had more cash in their pockets. What we emphasize at Tax Foundation is very much that long run sort of incentives for investment, sort of the longer term picture rather than the short term consumption component. But that component is very real. It's also important because, of course, that can add to inflation. It can, heat the economy. Sometimes that's beneficial if you're in a recession. Sometimes that can add to the an overheated economy, which we're now concerned about having the episode we had in 2022 and 23. So I think both sort of stories are important. They're tied together. They're intertwined. I think where folks get mixed up is if you sort of mix up those stories, right? So if you tell the story about growth in the context of just more money moving around. When no, it's actually more about how do we encourage behavior on the margin. That's more important than moving money around as quickly as we can for the long run trajectory of our living standards. And it's also important in terms of policy design. I think you hit on a really, really important point, which is, President Trump has some very strong political instincts. I think really understands people's intuitions and what people are yearning for. And he hit on that in tax policy by providing proposals to exempt, tips from income, overtime pay, Social Security benefits. That also, I think, touches on some intuitions of fairness people have about Social Security benefits, right or wrong. I think that's why those proposals were popular and why the president latched onto them. What will be important now, of course, from the policymaking process perspective is how does Congress respond to that? These proposals need design details. They need legislative language, right? They're going to need regulation inevitably. They're going to cost something. So we need to just decide how do we balance that in what is already a tricky set of budget math. So I think those are going to be the questions that are going to be before Congress. We do know that President Trump's already spoken with congressional leadership on exempting tips from income tax. So we know that's likely on the table. I think the big question is, I guess two questions are, how much of this ends up in a hypothetical package? Is it just a portion of these ideas? And then are these ideas piloted, right? It's possible that they may be a temporary exemption for certain types of income. That then because some of it is an experiment, right? We haven't done some of this before. We can see how people respond, how popular it is, and make decisions later. That'd be another way to constrain the cost while also ensuring the president can fulfill some of his promises.
Yeah, so let's talk about that. Let's talk about behavior. You bring up behavior, and I think we can I think we need to separate between extension of the 2017 Act and the behavior consequences there versus the new proposals, such as overtime pay, Social Security tips, SALT, et cetera. And the reason is because my theory is if they don't extend the 2017 law, people will see that as a tax increase.
Yes.
It's interesting when you talk about scoring, meaning how do you pay for it? You're talking about, well, wait a minute, we have to pay for this.
Preserve the status quo.
Increase, but nobody's going to see it. Nobody sees an extension as a decrease.
Right.
They see an extension, a non-extension as an increase in taxes. So, of course, the economy is a confidence game, right? How much confidence do we have in our spending? I mean, that's why when the stock market goes up, people spend more because they have confidence that their 401k, right? They don't have to save, their retirement is secure, or they've got some savings, et cetera, because it's confidence. But if they see, so starting with 2017 law, if that's, first question is, do you see that ignoring the peripheral issues like the research and development deduction, which I think everybody agrees needs to come back,
right?
And bonus depreciation, which I would hope that one comes back too. But ignoring those very specific, which those would actually be considered to be reduction because they're currently out of the law, right? Or phasing out of the law quickly. I think that what I want to look at is, how do you think, based on what you're seeing and what you're hearing, do you think most of the 2017 law will just be extended or made permanent?
So I think the overwhelming priority is to make as much of the law extended and or made permanent as possible. I think that is the driving force and the top priority. One sign of that, just tangibly last week, is there's now been proposals to maybe split the tax component of all of this into two, with the first part just being for certainty purposes, extending or making permanent as much of the 2017 law as possible, and then a second part being anything new or adjusted. That's hard to do for procedural and political reasons. For SALT and other things, there may not be the votes to do that. But I think that does underscore the important point that I think Congress, and I'm sure President Trump here loud and clear, they need to avoid what people see as a tax cliff, right? They're going to see meaningful increases in their tax liability next year once they file their taxes in that following spring than they do now. And so, and that does, and I think you hit a really important point, right? That people are going to see what might be, a real victory of avoiding this tax hike, but it's merely preserving mostly the status quo. Right. So it's not an additional set of tax cuts. And that does, and maybe that's another intuition the president and his team had, which is we need to add a sweetener to this so people can see further progress. It's not enough just to maintain the status quo and avoid the cliff. And so adding in, exempting tips from income tax or doing something more broadly on overtime and Social Security and among these other changes would at least add to that perception that, we're continuing to build on the law. Because that is
people aren't going to see an extension of 2017 law as progress. What they're going to see is if it's not extended as a regression.
Exactly.
Right? That's what's going to happen. I mean, that's the way, wait a minute, my taxes went up in 2025 versus 2024. That's what they're going to see. And when you have a president that is in his inauguration speech is very much about, hey, we're going to make America great again. We're stimulating investment in the U.S. economy, et cetera. That by itself is not going to cut it, but you can't have that. You can't be putting brakes on it like that. So it seems to me like most of 2017 would be extended, because otherwise, I mean, for example, you took the small business deduction away, the 20% deduction, you're going to have an uproar
Mhm.
in Main Street, right? Because that's Main
Right.
Street. And so let's talk about the rest of it, which is and let's talk about what's most expensive, for
Mhm.
example, what's likely, what's less likely, so that we can kind of plan for this. So we're kind of planning. Okay, 2017 law is going to be extended. Let's start with the ones I left out, which are research and development and bonus depreciation, and then let's talk about an additional corporate tax rate cut, because that's been
Mhm.
discussed. Those are the investment provisions. The others are what I'd call consumption provisions.
Mhm.
So on the investment provisions, where do you think those are going to end up, and how are they going to pay for them?
Yeah, so I think one sort of positive note about those, particularly with R&D expensing and bonus depreciation, is there is actually, there's some support even on a bipartisan basis for some of this stuff. They were notably included, extending bonus and reverting back to R&D expensing was included in a bipartisan bill last year that Ways and Means Chairman Smith and Senate Finance Chair at the time Wyden worked on, that passed the House, didn't end up passing the Senate, so it died. But it basically was a package that included extending those provisions, combining them with some changes to the child credit. And so, if anything, I think those would be, have bipartisan support and are definitely of high priority to Republicans. I think the key question is the design of, well, two things. One is, to what extent do they, and it's a little wonky, but it's, I think, important for maybe for some folks, which is, do they restrict either bonus or R&D expensing, or both R&D expensing and bonus, to domestic investment versus all investment that could be eligible? That came up last year. They could be restricting that further, mostly in an effort to try to encourage domestic investment specifically. The second, of course, is how long is this extended for? There's incentives, I think, to maybe only extend it for 4 or 5 years, because it's a lot cheaper relative to the way they use the baseline to do that rather than make it permanent. So if they were trying to make the budget math work, they might extend these things for 4 or 5 years and then hope that, hey, these are bipartisan proposals that we know some Democrats like too. Maybe they'll be extended again in the future. Not ideal from a growth perspective or from a certainty perspective from us, but better than letting them die.
Well, and we know it
So,
doesn't always work that way, because that's
right.
why we got the R&D expensing limitation in the first place, because
Yes.
everybody goes, hey, it's
Yep. It'll be.
bipartisan.
Mhm.
It's kind of budget magic is all it is, smoke
Right.
and mirrors, but we're going to get it back before it ever expires. And we didn't.
And we didn't. Yeah, yeah. Same thing happened with the 21 ARPA child tax credit, right? For Democrats, they bet that, hey, we're extending, make it temporary for 1 year. There's no way they'll let it expire, and they did. So I think you're right. It's a really big bet. It'd be better rather than doing that to make it permanent. But that would be a key question: is do they
Interesting.
extend it further? And that's of course true of all these things. Do they do a 4 or 5 year extension, and then we're just back in the same soup again a handful of
Yeah,
years from
but that's interesting
now?
that you say that. Look, if it seems to have bipartisan support, it's actually more likely to be temporary.
Right,
Because
exactly.
because what
That's
what
right.
we do know is the Democrats, no Democrat is going to vote for this tax bill.
Right.
They've drawn a line in the sand from the beginning. They don't care
Yes.
how good the tax bill is. And this is true. This is our partisan politics that's been going on for the last, frankly, 20 years, since Bill Clinton, right? Since Bill Clinton, it's been partisan politics
Mhm.
this way. And so that's a really interesting point. So if we see bonus, it might be narrowed. The research and development might, and they might just be extended for a few years. What do you see about the corporate tax rate reduction? Do you see that being just for manufacturing, which they could do through, say, bringing back the domestic production activities deduction, or do you see that as being more broad based? Because one of the things that I thought back in 2017, you push us to a 21% corporate tax rate, we're basically now equal to everybody else in the world.
Right.
You put us as a 15%, we're a tax haven.
Hmm.
We're a tax haven.
Right.
Now we are now Ireland,
Right.
right? Where people
Yeah,
are
we're very good at that
where
point.
where you're actually headquartering here, just like Apple Microsoft said we're headquartering in Ireland,
Right.
right? So you're actually reversing that trend. Do you see that as a potential?
So I think there are some folks who for sure want to continue to build on the progress we made in 2017 because you're right. We went from near the top of the OECD and the developed world in terms of the statutory rates combined with the state rate to about average. And so by lowering it further, we can become even more competitive. I think it's more complicated now than in 17 for a couple of reasons, right? One is, of course, not to keep beating a dead horse, right? But I think the budget math is hard here because it costs about $100 billion over 10 per point that you want to reduce the corporate rate. And so it ends up being pretty expensive when you want to drop it 5 or 6 points relative to everything else. So that encourages either, taking that off the table or, as you said, maybe limiting it some ways. President Trump ran on trying to really encourage domestic manufacturing this way. The simplest way would be to bring back either in total or in some variant, the version of 199, the domestic production activities, the domestic production activities deduction, or maybe even narrowing it even further to basically excluding anyone who has any international presence as defined under this proposal. That would make it cheaper for sure. It would reduce the number of folks eligible for it, and probably change some firm calculations a bit. It also makes it a little more complicated. But generally speaking, I think going back to the point from earlier, right, the main priority right now, a lot of the oxygen is focused on avoiding this individual tax cliff. And so the question is there enough oxygen and budget math to add in a corporate rate change? The other thing that makes it slightly complicated, and I think this is a bit overstated in some circles, I think it does have some truth to it, which is there is a larger contingent of Republicans who are a bit more corporate skeptical than there were in 2017.
Mm-hmm.
And so, some folks even go so far as to say, "Oh, we should have a corporate rate hike." I think that's probably off the table. There's not interest in that, especially by leadership in either chamber of Congress amongst Republicans. But that does make it a little harder to, rally
to reduce rates
or a narrow margin to reduce it further.
Got it. So
that'll be tricky.
So let's talk about the consumer side of things.
Yeah.
Okay. You see an extension of the 2017 tax rates. Certainly, under Harris, we would have expected an increase in the personal tax rates, certainly at the upper level. But you're not seeing any pressure to increase personal rates at all, correct?
That's right. I think that there's strong interest in preserving the design they made in 17 for the rates and brackets, as well as just that broader, increase in standard deduction, the swap of the personal exemption and the child credit, because that did, of course, reduce the number of itemizers and a lot of simplicity benefits. A lot of it netted out to not be a big revenue change overall. And so I think that, if anything, I think that core design would be the thing they'd want to start with. It's the easiest thing to lift on.
Okay.
So expect that to continue.
Good. So let's talk about some of these others. Let's start with the ones that seem to be gaining momentum. And the first is my least favorite of all deductions, the state and local tax deduction, because I think it makes no sense to be able to deduct state income taxes. Probably before you were born, we could actually deduct federal income taxes on our state tax return. I remember those days. Okay. Yeah. The states had no problem getting rid of that deduction, but they really complain when we get rid of the federal deduction for state income taxes. So what is your take on, first of all, I'd like your take on the SALT deduction, how you think of, what you guys think about that. And second of all, if they raise the SALT deduction, will they bring back the alternative minimum tax, or are people just going to get a windfall? Because a lot of those people, frankly, a lot of people who are complaining about the $10,000 SALT deduction got no deduction under the alternative minimum tax. And so how do you see that playing out?
Yeah, on SALT, it's been a rancorous debate over the last few years, really since 2018, where there's been a contingent in both parties who are very interested, representing certain districts that were impacted by it, in either getting rid of it or drastically increasing the cap. Democrats notably tried to do that in Build Back Better a few years ago. They didn't succeed. Of course, to some extent, they have their wins at their back now because the cap is scheduled to expire, so it needs to be renegotiated, and there's a very tight margin in the House. So that's why we expect this to be a point of contention. We know the president met with some of these folks at Mar-a-Lago and again in D.C. over the last few weeks. The main debates over SALT sort of surround, of course, it is considered, the one of the base broadeners in an effort to broaden the base and lower the rates. So it was, it adds up to about $1 trillion over 10 years if you continue the $10,000 cap. So it's real money we're talking about. So that's one reason why Republicans relied on it in 17 and want to continue to rely on it moving forward to help with this budget math. It's also seen, as you said, right, as a from a policy perspective, it doesn't make a lot of sense to effectively reduce or subsidize state effective tax rates for states that have higher high tax, high service, models in certain parts of the country. And so it's, effectively subsidizing that activity at the expense of other states that don't have that model. And so there was that, and that's run into, partisan debates as well about the cap and its relative effects. And of course, the point we make, and I think you just hinted on it, right, which is it is true that on a gross basis, looking at it in isolation, the SALT cap does increase tax liability at the federal level relative to if it didn't exist. But you have to net it out against all the other changes. The alternative minimum tax is one that's under discussed, as you just said, that needs to be controlled for because we made that a lot less binding for a lot of folks. And of course, the rates and brackets and other tax cuts mean that a lot of folks who are complaining about the SALT cap still saw a net tax cut from TCJA. And therefore, if it expired, they'd actually still see a tax hike even with SALT uncapped. And so I think that's an important under discussed point. The other point that's made, of course, is the progressivity argument that it does accrue to higher earners. And does it make sense to sort of double down on that from a distributional perspective? All that said, I think it is very likely that the current policy design will change. The simplest one, the one that's probably the most incremental, is just to deal with what is known as the marriage penalty, right? Which is all filers have $10,000 cap, regardless of their filing status.
Oh, interesting.
Two folks who get married have a higher tax liability than if they were separated. So you could double it for joint filers. That doesn't cost a lot of money. It does have a policy rationale, and it does allow some relief. The big question is, to what extent do the pro-SALT folks find that good enough, or do they want to see an even more generous cap? And so it's going to be that back and forth. I think the big question is, what is the consensus design they can come up with?
Interesting. So alternative minimum tax, that's also temporary, right? So that would come back unless it were extended. Do you see it being extended to the way it is right now? Because that has like you said, that's a big interplay because state and local taxes are not deductible under the old alternative minimum tax, right? At all. And that's why my clients who lived in high tax states didn't get the state and local tax deduction because adding it back in caused them to pay the alternative minimum tax. So it was just an offset. That's all it was.
Right.
So do you see that those will be tied together, or do you think that the SALT's going to be treated separately this time from the AMT?
Yeah, I think there's probably interest in the simplest thing is just to continue the current policy of, both the existing SALT cap and the AMT design. Because on the AMT side, of course, that also simplifies things for a lot of taxpayers. The number of taxpayers who fell into the AMT after TCJA was a fraction of what it was before, right. And we continue that the policy win. But I would be curious to know, like, if they were to unwind the SALT cap in some way, will there be interest in unwinding AMT? If not for all taxpayers, at least for those folks who are electing that higher SALT amount. And so, of course, that would have its own complication, and you have to have an additional set of law and to deal with that. But that in IRS guidance. But that is, I think, another downside for reopening the SALT debate is you do have to control for this, otherwise it's a windfall. But the trade-off is you end up back into sort of applying the AMT to a higher subset of taxpayers.
Right, super complex regime. Right. I mean, it's horribly complex, and no tax professional, no taxpayer like the AMT. So all right, so that's one. We basically what I hear is we're going to see an increase. We don't know how much that increase is going to be, but we're going to see an increase in the SALT cap, whether it's 10 to 20 for everybody, 10 to 20 just for married. I'd love to see the marriage penalty go away, being subject to the marriage penalty. It's a pretty big penalty, actually. It's a penalty in the rates. It's not just a penalty in the, but there's no discussion about the marriage penalty going away that way, is there?
No, not at this point. It looks like that underlying penalty in the rates and brackets probably will continue. Of course, it's been baked in there for a while now, but that's something we continue to, not great policy. The challenge with all that in the tax code, of course, is you could try to get rid of a lot of the marriage penalties, but sometimes you also get rid of marriage bonuses as a result too. So how do you deal with that?
Yeah,
That's a
that's
bigger
fair.
project.
That's a good point. But okay, so let's talk about the next one that is most discussed, which is the tips, and that's
Mhm.
to me the most complex one, the most problematic one because anybody can get a tip. So how do you narrow it? A lot of discussion right now about how to narrow it. I don't hear any discussion about not doing it. So it seems like this one has the momentum that it's going to get in there somehow. Uh, how do you foresee that it will be that it could be limited? Who's it going to be limited on? And what do you see as the consequence? I'm really curious to understand because a lot of our listeners they might have businesses that their employees get tips, right? They
Mm,
have their hairdressing salons, hair salons, or restaurants, or hotels. These people, these are your standard tip receivers. Although these days everybody asks for a tip, right? I
right.
mean, literally, it's on every single stripe or anything you get it asks for a tip, even if it like, but you didn't do anything. It's like you
Right.
pay for your Starbucks coffee at the register, they did nothing but give you your coffee and they are asking for a 22% tip. So what do you see there as to actually what's likely to happen?
Yeah, I think this train is definitely rolling out of the station for sure, and I think some variant of it will show up. Of course, there was one question of to what extent would this be focused narrowly on income tax rather than income and payroll tax? Seems likely because of Senate rules for reconciliation that likely that tips would still be subject to payroll tax, and of
Right.
course that matters for employer reporting that it won't completely
Complexity.
go away and the complexity there because you still
Yep.
got to deal with the payroll tax side
Yep.
even though the income tax side is exempt. The other, I think, key question as you just raised was to what extent are there any guardrails on this to ensure that there isn't a proliferation of either trying to apply this exemption
Hey,
elsewhere,
I'm happy to
recharacterizing
change
income as
my I'm
tips.
happy to change my
Right.
invoicing to include tips if they're
Exactly.
non-taxable.
And there have been some proposals out there that I think are actually fairly thoughtful, right? For example, there is language under existing law defining who can claim, the tip credit, to industries where tips are, historically, customary, and you could start there to ensure that there isn't sort of broad tip creep. That's one way to deal with it. Of course, there's still going to be edge cases where folks say, "Hey, I should still get this exemption even if I don't fall under this definition." So there's going to be questions there. Is this going to be an unlimited, exemption for purposes of tips, or do they put some other caps on it? That's another question to either limit the distributional impact or the revenue impact. I haven't heard a lot there, but that's another tool in the toolbox they could look at. But I think you're right that there is some concern that this would continue to maybe worsen the tipping culture or sort of continue that debate about the status of tips in the United States. It could have also, interestingly, some real labor market impacts, right? Because if you do have a job that, all else equal, similar incomes, but a good portion of your income is tax exempt in one job and not in another, it actually makes that former job more attractive and could
Mm.
increase demand for those jobs. That could also, of course, when you think about the economics of it, put downward wage pressure to some extent if there
Yeah, so
is
you talk
room
about
to do this.
dynamic pricing of these tax proposals. That
Right.
would presumably have to fall into that dynamic pricing where
Yes.
instead of looking at it static, okay, let's assume no behavior changes, behaviors change, and therefore we have more people in that industry. And actually,
Right.
could it actually encourage more businesses to form in
Mm,
that industry because
right.
they have cheaper access to labor.
Yes, I think that's right. Yeah, to the extent that there is room for downward wage pressure, that could be a factor, right? Or effectively, in wonk speak, the benefit or the incidence of the tax cut is actually some of it is accruing to business owners indirectly in that way. And so I think that's another interesting point where we start with this exemption and then you got to trace all the steps out, what's actually going to happen. And I think a lot of that depends on the design, how broad this thing is. How durable is it? If it's only 3 or 4 years as a pilot, that's different than if they say, no, we're doing this for good. One argument in favor of it is, hey, this is how things used to be in practice, right? They go back to, 30 plus years ago when, yes, technically it was always taxable as income, but there's a lot of evasion. But of course, it is, very different when, the government codifies that and changes that compared to how it works
Well,
today.
that's a very good point. Is that how much does it really cost? Because
Right.
you do have a lot of people. We all know that tips are not all reported, right? I mean,
Yes. Yes.
that's
Yeah.
that's a
It's
fact.
still,
So
yeah,
so
that's right.
so it basically legalizes what people are currently doing that are cheating basically on their
Right.
taxes. Okay, so we're going to get some kind of tips. Any of these other proposals that you think will get legs, overtime pay, interest deduction on U.S. cars, which I actually don't really oppose too much. I kind of it's almost a consumer slash investment type
Mm,
of a tool. That one is, or Social Security taxes on Social
mhm.
Security income, which is such a silly thing to be taxing something that you paid for in the first place. So
Mhm.
it's that's a bizarre. To me, that's always been a bizarre tax that you have it at all. Any of these other things that you think will get legs, or do you think this is going to be contained to 2017 salt and tips?
Yeah, I think tips leads the way. The Social Security benefits one is challenging because I'm not sure how if in the Senate they're going to be able to do it because it does the tax that's paid on those benefits goes back into the trust funds.
Right.
And you can't touch a lot of that in reconciliation. So it's possible that might be ruled out anyway. So it sort of takes it off the table. Overtime is another interesting one where there's, without getting too in the weeds, there's even more design details on what is in and out, what's exempt and what's not. That could also get very expensive very quickly, depending on, because there's even more avoidance
Right.
questions of, hey, people could increase their overtime work. They could recharacterize their income to try to get more of it in categorized as overtime. So that one's trickier to legislate, and so I probably put that behind tips. The other one thing I haven't heard much on at all, though it is an interesting idea. One question there is it an above the line deduction or is it itemized
Yeah.
deduction? That makes a big impact on who can claim it and
Huge.
how expensive it is. And of course there are others that are sort of less talked about, right? So I think the president mentioned like new credit for home caregivers. Not sure if that'll come about. That could make a meaningful difference for certain taxpayers who are in
What
that
what 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 what
category.
about the child tax credit that Vance has talked about?
So the priority there, I think, is of course to preserve the underlying credit that was expanded in TCJA. So we doubled it from 1,000 to 2,000. We changed some of the phase-ins for it and the phase-out thresholds. Like keeping that and avoiding it going back down is going to be the priority. I think there's far less agreement on what to do with it after that. As you said, as you mentioned, Vice President Vance mentioned a major expansion during the campaign. I think recently the vice chair of I think in the Republican caucus also had a different proposal to expand the credit. But there's a lot of I think disagreement still amongst in the caucus of how much to expand it by and how exactly should that be designed. There's still a lot of support for preserving work incentives in the credit, and so I expect unless they coalesce on something over and above the TCJA credit, that'll be the priority and probably the major focus.
Okay.
Um,
So none of these things are revenue raisers.
right.
So
All
is
kinds
this just going to add to the deficit, 5 trillion, $6 trillion to the deficit, or are they actually going to come up with some way to pay for it?
So right now, I think that is actually probably a lot of the work that the major committees, Senate Finance, House Ways and Means are working on is coming up with a menu of items. You may have seen it was reported there was actually I guess a leaked, there was a 50-page basically menu of a ton of different options to potentially use as offsets. I interpret that as a very early stage, sort of brainstorm, if you will, of items. There's a couple of things there to point to, right? One is, of course, as we mentioned earlier, the specter of tariffs is a big one because it is a big revenue raiser. It could raise anywhere between 1 and 3 trillion over 10 years, depending on how aggressive you get. Big question there is, does Congress lead on that, or does the president? That also folds into what the official numbers look like on the Hill. So that's a big one that we'll have to continue to watch. Another one that's coming up, of course, is a partial or complete repeal of the Inflation Reduction Act green energy credits, which can add up to 800 billion to over $1 trillion over 10 years. That of course, have big impacts on businesses in the space. There's going to be a push and pull there, I think, with Republican members who represent districts where a lot of that investment from those credits is happening. So we'll have to see what they come up with there in terms of how aggressive they get with those credits. And then there's like more aspirational sort of proposals to broaden the tax base, deny certain deductions beyond current law or current policy, do things like expand the endowment tax, which has been talked about a little bit. But the big challenge is, can they, wrangle enough members to actually support any of these tax hikes is, I think, the big question. The first thing we'll have to do is to come up with a budget resolution in the next couple of months with a agreed upon deficit increase. And that's where they have to start is, what does that number look like, and can they make the math add up for the rest of these cuts and hikes?
Got it. Anything that you would caution business owners, entrepreneurs, investors to be wary of? Any potential kind of ideas in deep dark corners that might surface that could catch us unawares?
That's a good question. Of course, I mean, I think that the big thing, of course, to continue to watch for is there is continued interest in certain base broadening. I think a lot of that is going to be politically very hard lift, but that could impact businesses in different ways depending on what they do there. There's lots of different ideas. I do encourage folks, if you want to go check out that menu of options that was leaked out from the Hill, that gives you a really good sense of what they're looking at.
Do you have that on the Tax Foundation website?
Yeah, well, I can send you a link to that, and you can include that.
That'd be great. We'll post that.
To be helpful. Yeah, and I think it does give you a sense of the range of things they're looking at, and so I think that's a good place to start. But I think there aren't a lot of other major surprises. I think one question, of course, in addition to the temporary versus permanent debate, is to what extent is any of this stuff applied retroactively? I think some folks do expect some of that. There was some of that in the bipartisan tax bill that went nowhere last year. And so, of course, that would impact business owners who may want to amend returns, who may find an advantage of that, of doing that, depending on their situation. And so I think that's something to watch for. Is for some folks it may not matter, but others it may matter a bit in terms of the timing.
Well, the R&D expensing would be the big one right there,
right,
because
exactly.
We have. I mean, I have friends that they paid an effective tax rate of 80% because of that. And because of that, so that would be actually huge for those people. Final question. ERTC, which is a big number still. It's a big number. Last I heard, the IRS is up to July of 2023 applications.
Right.
That's how far behind they are. And I'm going to ask this in conjunction with what happens to the $80 billion or now $60 billion that was given to the IRS, because they used it as a revenue raiser in the Inflation Reduction Act, but I could see it actually being used as a revenue raiser to not give the IRS that money under, under the Republicans. So what do you think happens there? Do you think they do anything legislatively on the ERTC? Because that was proposed. That was actually the way they were going to pay for the bonus depreciation and R&D expensing. So will they restrict that? Because people are still applying. They still have some time here. Or do you think that that's just going to kind of work its way through the system? Billy Long, maybe he'll actually, maybe the new IRS commissioner will actually move it forward. And then what do you think happens with the money that's been designated for the IRS?
Yeah, and the ERTC, I think, that was very much a casualty of the of that bill dying sort of all at once. Because along with sort of broader COVID recensions, I think there is a strong appetite to wind that thing down because there's been so much fraud and concern over that over the last year and a half, and it's been a really, I think it'll continue to be a case study moving forward of a policy design gone wrong there in tax administration for sure. But it will be somewhat of a balancing act, because stuff like changing the statute of limitations for fraud and other enforcement strengthening, which was a big part of that revenue score, that all probably makes sense, and I'd be surprised if they didn't move forward on some of that in a reconciliation bill. I think one question is on sort of the cutting off, especially active sort of applications for the RTC is what if there is a residual of firms who really did legitimately claim it, have late,
and there are.
Exactly. You don't want to penalize them just because of all these bad actors. So how do you deal with that? That is one argument to allow the IRS to do its job, as long as they're doing it well with oversight, to separate out the folks who are improperly claiming it from those who are have been late. And so maybe that might be the balance to strike is focusing on that the statute of limitations and the enforcement side rather than just carte blanche, cutting things off, which was part of that. So I think that part would be the main debate there. I haven't heard a lot about it recently, but there are a few champions on the Hill. I'm sure we'll make sure there's something addressed there. And of course, the other big thing is what do we learn moving forward so that doesn't happen again in future programs is another important point that we and others are emphasizing because we don't want to have that be a lost lesson. And then on the IRS funding, I think that's going to be the remaining. I guess it's 60 billion. I guess 20 billion of that I believe is actually still on hold because of some of the
Right.
process related stuff for the budget. It's going to go headlong into some of the scoring, which, as you said, like on a sort of the money itself, if you were to repurpose it, that's a savings. But of course, CBO and others are going to say, well, like there's enforcement revenue that we would get in the future, so it's actually a loss. So there's going to be that debate about how to interpret that, whether or not that matters. I think it may continue to sort of create some tension between Republicans and the scorers on the Hill. The other thing that Aaron Collins in the National Taxpayer Advocate report that came out to Congress a couple weeks ago was, hey, like there still is an underemphasis on customer service.
Right.
And the virus has made some progress, but they continue to lag on, paper processing. As ERTC is still behind. You still have issues with some of the electronic tools. I mean, there is an opportunity here to repurpose some of this money specifically for taxpayer services. So that's another sort of option on the table moving
Well,
forward.
that is certainly my hope, and the hope of a lot of our colleagues is that rather than take all the money back, they repurpose it away from hiring auditors and put it to
Right.
technology and customer service. You get so much better. Every business owner knows
Mm,
you get so much better revenue when you take care of your customers than when you
right.
don't take care of your customers. So to me, putting money to customer service actually does more for increasing revenue than enforcement does.
Mm,
Okay, enforcement's a very negative thing. I mean, nobody likes the IRS. I've never met
right.
anybody who says, "Hey, yeah, my best friend's an IRS auditor," right? I mean, everybody's, yeah, I know an IRS auditor, right? Or
Yeah.
this IRS auditor is now my accountant, right? They're telling me all the things that I can do and how to get away with things, and so I do think that it would be. I mean, this is my own plea is that they do actually put money to customer service. We know customer service
Yeah.
works.
Hmm.
Customer service is a really good expenditure of funds of any business and any organization. And the IRS, they say they've done better, but they have not done nearly as much better as they say they've done.
Right.
Okay. So when they say they answer phone calls in 15 minutes, I think they just actually you get your message within 15 minutes, but you don't actually talk to a
Yeah.
person in 15 minutes. I mean, even tax professionals, we can be on hold for 2 hours still. So it's pretty sad. Any final words or predictions that you have for how this thing progresses? And maybe one thing to address in those final words is, does this happen early in the year or late in the year?
I was just about to get to that, which is, they're still they have not even finalized the process under which they're going to go about this. So I think one detail there that hinges on all of this is do they try to run this entire agenda through one bill or multiple bills? That's been a big debate since December on the Hill. If one argument is, hey, throw everything into one big bill, so that'd be tax, the border, immigration, energy, dereg, anything else and try to pass it probably in the first 6 months of the year. And that would be there's some benefit to that. Members only have to vote once, and you get it all done. But it means much like this bipartisan bill on tax, it all rises and falls together. It also means that some stuff like on border funding comes a little later than otherwise might. So the alternative is to structure this into chunks where one chunk is the spending changes, regulation, energy, and then the second chunk is tax. In that scenario, I think the tax stuff happens later in the year, likely in the fall or at the end of the year. My prediction or and anything can happen would be that's the most likely scenario as we see some of this other stuff happen beginning of the year and then the tax stuff happen later on. And there's been proposals to maybe structure this differently, but that it just gets hairier and more complicated the more you try to separate this stuff out. So that's the more likely scenario is structured into two. And then either way, the two areas you want to watch for is the work session between now and roughly Labor Day. That will tell us a lot. and then the work session from beyond August to the end of the year. The one thing I will say, of course, is if they can't come to an agreement on a broader tax package, the fallback option is just to extend current policy for a year or two. Republicans would have another shot at the apple next year if they needed it. That actually did happen. There's a historical parallel here about 10 years ago. People may remember it was in divided government, but it's still interesting that then President Obama and Speaker Boehner came together, extended the 01 and 03 Bush tax cuts for 2 years from the end of 2010 to the end of 2012 before coming to a deal. So there's some historical precedent for that, but that would be their fallback to ensure that at minimum we avoid that big tax cliff at the end of the year.
Got it. All right. Well, thank you, Garrett Watson. Tax Foundation is such a terrific, taxfoundation.org, such a terrific resource. I highly recommend it. Garrett, if you'll send me the link to the potential pay-fors there, then we'll put that in the show notes here. And please share this. This is such an important dialogue because we're planning now we're planning for all of 2025. And a lot of this, I mean, here's an important point we really didn't talk about is when does it become effective? You talked about retroactive, but do you think, I'm going to ask you this one last question. Do you think, Garrett, it will at least go retroactive to the beginning of 2025? Or will it be as of the end of 2025?
I think for items that would change the law, that would hypothetically change the law for this year, it's likely they would at least apply it to 2025. I'd be surprised if they didn't. Of course, a lot of it will only change underlying policy beginning next year. But for some of the stuff, I think the big question is, do they apply it to 24 and before that? Right. I think there's probably some interest in just letting that be. But typically what we see is stuff applied at the beginning of the year. That's been especially true for tax hikes for purposes of making sure people can't plan around it. But I think it's also true of this package too, is starting at the beginning of this year.
Okay, that's good to know. Please share this. Getting the financial education like this is so important as we project out our year for our business, because the single biggest anchor or weight you have is your taxes. And if you can relieve that weight, if you can predict what's going on, then you can plan for it. So there are lots of ways to plan for any of these changes, any tax increases we can always plan for. And we want to make sure that we're on top of this, because when we do, and be sure to, by the way, follow us, share it, because when you do, you make way more money and you pay way less tax. Thank you, Garrett. Thank you. By the way, make sure you thank everyone at the Tax Foundation for us here at Wealthability, and we'll see everyone next time.
This podcast is a presentation of Rich Dad Media Network.